Thank you for joining. I'm Mark LaMonica. I'm the product manager for Morningstar Premium, morningstar.com.au. And today we're going to talk about ETFs and ETF model portfolios. So hopefully it'll be interesting. A couple housekeeping items. First, so number one, anything you hear today is general advice. So I can't offer any personal advice because I don't know you. If you are in New Zealand, you should consult a financial advisor if you have questions that would constitute personal advice. And you can go and find the New Zealand FAP, which is on our website, morningstar.com.au. There you go. Always the hardest part is getting that New Zealand disclaimer out. So I've succeeded at something today, which is good. We'll see if we can keep it going. The other thing is I would love questions. So if you have any questions, just send them through. There's a Q&A button on your Zoom screen. There's also a chat functionality. Will, the videographer, is doing a lot of adjusting. Will's ferry broke down this morning. It's been a difficult day for him. Or maybe he was just late to work and made up an excuse, but we'll see. All right. So first, before we get into the ETF model portfolios, we are going to talk just in general very quickly about ETFs and a couple things about ETFs. So what is an ETF? There you go. There's your definition. ETFs are very popular right now. There's been a lot of money that's flowed into them, I think partially because they have very good marketing. But anyway, an ETF is an investment fund that's traded on a stock exchange. So it can hold multiple types of assets and low barriers to buy and sell. Mostly because here in Australia, in order to get into a fund, a lot of times it takes signing up for something that's on a platform or actually applying directly with the fund company. So ETFs are easier. People like them. You can trade them in your brokerage account. All right, let's look at ETFs compared to a couple other securities. And as I said, ETFs are becoming very popular. They do have very good marketing, but there are a lot of situations where you're probably better off using a different instrument. Not a lot of situations, some situations. So let's go through. We're going to look at equities, funds, ETFs, and LICs. So a LIC is a closed-end fund at the end of the day. We'll get to what that means. All right, so let's talk transaction costs. So this is where funds are very different. So anything that trades on an exchange, you are going to generally pay a transaction cost. You have to trade it through your broker. Depends on what broker you have, what that cost will be, but nevertheless, there's mostly a cost. There's also buy-sell spreads. So that's just the mechanism that you buy and sell anything on an exchange, is there's going to be a difference between what you can buy something and what you can sell something for. And that's obviously how everyone makes money in that. Funds, you don't have brokerage. So that's the advantage of funds. So if we think about the implications of this, number one is that if you are making lots of contributions, for instance, if you want to put a monthly contribution and invest it, funds are probably better off for you because you don't have to pay those transaction fees. So once in funds, and we'll get into some of the other attributes about funds, but that's something for people who are saving paycheck to paycheck, which is how most people save. So something to think about. You don't have to keep paying those transaction fees. Next thing, we'll go down to management fees. So of course, these are all professionally managed products, whether they're active or passive. You have to pay management fees. So they're none, obviously, for equities, but funds generally have slightly higher management fees. And the reason for that is there's a lot of fund administration that's involved with managing a fund and transacting in a fund. So you'll generally pay slightly more of a fee. And then LICs, you generally pay slightly more as well. Valuation method. So this is important. We'll get into this a little bit when we talk about trading. So funds always transact at the net present value, the net asset value, the NAV. So what that means is that at the end of every day, fund accountants will go and they'll add up all the securities that are actually held in there. They'll look at whatever those new prices are, and they will strike a NAV. That NAV is what everyone will transact at. So that's the thing about funds, and we'll get into trading flexibility. You do not transact during the day. You decide that you want to buy into a fund for a certain amount of money, and then the price will get set after the market closes. So that's what I'm talking about with all this fund administration that's around it, fund accounting and everything else. That is why you have that, and that's how you transact. You do not do that for ETFs. So there can potentially be a deviation from the NAV. And we'll get to LICs in a second. The reason for that is just the way that ETFs work. So basically the way an ETF works is that an ETF, because it trades on an exchange, just like equities, just like LICs, supply and demand is going to change the price of the ETF. Now, there's a mechanism in place to try to keep an ETF as close to that NAV as possible, as close to that net asset value as possible. And basically what that is the fact that there are arbitrage opportunities for investment banks to exchange shares of ETFs for the underlying basket of securities that are in them. And so what they do is that mechanism allows the ETF, or generally has ETF, trading pretty close to the NAV. So let me give an example, because this is confusing sometimes for people. So let's say you have an ETF, for simplicity's sake, that holds 10 shares. So you have 10 shares, you add up those 10 different companies, the shares that are held in there, and the ETF is $100. So the net asset value of that ETF is $100. So let's say the price, because of supply and demand, moves away from that. And I'll put a big price change in there just so it's obvious what happens. So all of a sudden, the ETF is trading for $110 when the shares are only $100. So this arbitrage opportunity, and arbitrage is a riskless profit. So what that means is an investment bank will go out and buy those 10 shares, and they will trade it for the ETF. They go to the ETF company, the management company, they'll trade those 10 shares, they'll give them a share of ETF, and the investment bank automatically sells it. So in that case, minus transaction costs, they make $10 doing that. Now the spreads are never that big, but because of obviously computerized trading and the fact that they can all do this very cheaply, that is what keeps the spread very, very close. So as you see deviations on either side, an investment bank trading desk will go out there and transact. Same thing on the other side. What they'll do is they'll go out and they will take an ETF share, they'll buy an ETF share, they'll exchange it to the ETF company for those 10 underlying companies in it, and they'll sell them immediately. That's what happens if it falls on the other side. So that's how a valuation method works on an ETF. And we'll get into the implications of that in a second. LICs are totally different. So they do not have this mechanism in place. So there can be a very large discount or premium to this net asset value. So that's different in LICs. Trading flexibility, we've been through this. So anything on exchange, you can trade anytime the exchange is open. Funds, you can't. So funds, you got to wait. Once a day, you can transact, whether you're buying or selling. So that's funds. Minimum investments, another big one. So in theory, there's no minimum investment for an ETF. Now, you're probably not the smartest person in the world if you're going out there and buying a $20 ETF for a $10 transaction fee. So there should be a minimum investment, at least in your head, but it's not like funds. So funds obviously can have, in some cases, very high minimum investments. But the good thing about funds is that once you've met that minimum investment, a lot of them will then let you transact continually, month after month, at a lot lower level. Behavioral risk. So behavioral risk just talks about our propensity to do dumb things. And with anything that's traded on exchange, there's more likelihood that you will do something dumb because you can. I don't know, the example I always use is you're on a diet, but you fill your house with a bunch of stuff you shouldn't eat. Well, the chances of you eating it are going to be a lot higher if it's in your house. Same thing with trading. So that's my stupid analogy. I'm getting laughed at. You can come up with a better one if you would like. All right. So let's talk about some of the different implications around this. Well, we have lots of questions already, so I will get to those in 1 second as soon as I go through what the implications are. Okay, so a couple different things. So one of the reasons, so if we look at different markets or different types of assets that we want to trade in, particularly around this valuation method, the more liquid the market, so the more the underlying securities trade. So if we think really liquid markets, think of like the ASX 200. The more liquid the market, the better it actually is if you're an ETF, because you're going to have smaller deviations from the net asset value. If a market's very illiquid, if it is something like small cap developing market stocks, if it's something like fixed interest, this arbitrage method that the investment banks do is going to be a lot harder, which means that they are going to wait for a larger deviation from the NAV before they'll actually act and bring it back close to the NAV again, the price of the ETF. So it's something to think about when you're looking at different markets and looking at what is better to use, what's a better instrument to use. So let's get to a couple questions, just because we had a lot on this slide, and we'll get into some other stuff. Okay, Rodney had a question that I hopefully just answered. He says, presumably for the larger index tracking passive ETFs, the market makers both keep them very close to NAV and smaller spreads. Exactly. So that's the other thing, the spread, that buy-sell spread is the other thing that matters in liquid markets. So if it is more liquid in terms of the ETF, now, if people are less interested in the ETF, if there's less assets in that ETF, that can cause widening buy-sell spreads. So that's the other thing that you need to consider. But Roddy, yeah, you're right. So the market makers will keep that spread a lot closer if the market is liquids, or as you said, large index tracking passive. Okay, so Lisa says, does arbitrage opportunity result in ETFs showing less volatility than equities? No, they'll basically have the same volatility as whatever that underlying security that's in there is. So remember that this arbitrage opportunity is only trying to keep the price of the ETF and the net asset value tight, close together, but they can still bounce around a lot depending upon whatever those underlying assets are. So it's going to stay close to it, but if there's a lot of volatility in that underlying asset that's in it, like if it's shares, there's a lot of volatility, then that ETF will also have it. Yeah, so John's asking what happens if the value of the ETF fall lower than the NAV. So hopefully I answered that. So basically they'll do the opposite thing. So if the ETF is lower than the NAV, then they'll go out there, they will exchange that unit of ETF for the underlying securities and immediately sell them. And I know this all sounds very complicated because, we just sit there and when we're trading, you're punching stuff into your, ComSec account. But obviously all this stuff is computerized. So it's automatically doing this as there's any sort of deviation. So Brett is asking this question. How do ETFs grow in size? Can they issue new shares as demand increases? Yeah, so constantly what they're doing, this whole process is arbitrage process. They're called creation units at the end of the day. So creation unit is just the way that we create more shares and more ETF shares is we are trading whatever baskets of whatever underlying securities they're tracking. So yeah, ETFs just continually grow in size, unlike a LIC. So the difference with a LIC is it is a closed-end fund. They never increase the number of shares. So that's why supply and demand can really cause giant differences between the price and the net asset value. So particularly times of market stress, where a lot of people are selling LICs, then you can get really big discounts between the net asset value and the price that it's trading at. And so in down markets, a lot of people like buying LICs because that spread, that discount widens. My computer just beeped, in case anyone's interested. All right. Minimum investments for ETF and LICs are really the same as direct stocks. Yep, Rodney, you're correct. It's whatever, the trade size is and whatever you think is worthwhile paying commission, right? So whatever depending upon your broker, whatever brokerage you're paying, obviously if you buy very small amount, you're going to have problems. But yeah, thank you, Rodney. All right, we're going to move on, which is exciting. Now, when I say trading tips for ETFs, I don't really mean trading tips, but anyway, people are amused at that. Okay, so a couple quick tips on if you're trading ETFs. All right, so first tip, check the spread and the market depth. So a couple things about trading ETFs. It's generally not great to do it right when the market opens or right before the market closes, particularly if you are buying global products, so non-Australian. So you're buying an Australian listed ETF, but you are buying an international share ETF. It's not great to buy them right around open and close, basically because there's a lot of volatility then. So at the end of the day, wait a little bit, wait until the middle of the day, because the spreads are always wider right when the ASX opens, and generally right before it closes. And so think about that, because people are out there looking at futures. So if you're buying like a U.S. underlying U.S. assets in an ETF, once we get to the end of the ASX day, right, people are starting to look at futures the next day opening up. And so you could see lots of weird stuff happening. So yeah, buy during the middle of the day. And generally you'll get a smaller buy-sell spread. I can't get that into my head for some reason. I've been here 6.5 years. Buy-sell spread doesn't make any sense. Bid-ask spread is what I want to say. But anyway, nobody cares about that. All right, so limit orders. So we do recommend, and this comes from our manager research team, not me, so they actually know what they're talking about. We do recommend using limit orders. What a limit order basically says is that you are willing to transact at a certain price, rather than a market order where you're just going to get whatever your broker can go out there and fill. We think limit orders are a better way to go. The problem is that if you have a pretty illiquid market, that you could get an order fill at all sorts of different prices that could be quite far apart. So basically what they'll go out there and they'll partially fill those orders. So you say, I want to buy 100 shares of, well, I'm thinking of a liquid market now because I can't think of anything else, Vanguard Australian shares. You want to buy 100 shares, like they don't necessarily have to transact, and they won't generally transact 100 shares at a time in a block. They might fill 20 at one price, 20 at another price. So you could have issues around illiquid ETFs, just because they're not able to fill that whole order at once. So that's another one. But if it's a large ETF and it's very liquid, then it probably doesn't matter, and you can use just a market order. Yeah, take a long-term mindset. This goes back to that behavioral risk piece that we talked about. Just because you can do something doesn't mean you should do something. So don't trade too much in ETFs. I know everyone likes them because you can trade a lot, but we also know that trading's bad, and it generally leads to poor outcomes. But take that long-term outlook. And then finally, we don't think that you should use stop loss orders. Once again, especially in a liquid market. So all of these warnings are kind of the same. Liquid markets can be problems for ETFs. So look at the liquidity, and that's that whole thing on the top, the spread and the market depth. So market depth is not going to be great if it's in a liquid market. So yeah, we think that these stop loss orders, that's when you put in that, hey, you're going to sell something at a certain price, is that sometimes these can be executed at times that aren't great for you as an investor, basically when a spread is really, really wide. So yeah, we think obviously for long-term investors, this stuff is less relevant anyway. All right. Let's see. Let's go into, we're going to go to the website, which I don't think I've opened. I was very disorganized today. I have to go on this weird panel discussion tonight with the equity mates. I don't know if anyone's listened to the equity mates. Listen to our podcast instead of them. We're better. But yeah, I'm doing a panel discussion at a brewery tonight, which I guess is exciting, but we'll see what happens. All right. So we're going to talk a little bit about building a portfolio, and we're going to talk about ETF model portfolios. But first, and I'll keep this very, very brief. So obviously, anytime that you are building a portfolio, it starts with your goals. And we have whole webinars on this that you can go on our YouTube channel and watch. Start with goals. You calculate a required rate of return. That's the return you need to achieve your goals. You move into asset allocation. Now, what we have here, and this is our website, by the way. What we have here is we have 5 different asset allocation models, everything from conservative out to aggressive. And that's what we are basing these ETF model portfolios in. Now, each one of these, obviously, depending upon what your goals are as an investor and how that aligns with or what that required rate of return is and how that aligns with asset allocation, is for different time frames and different expected returns. So you're obviously getting more aggressive in more growth assets if you're in an aggressive portfolio, and then way back in our conservative portfolio, you're very conservative, so lots of defensive assets. So for instance, we go on here, we have suggested asset allocations for all of these different asset classes. So what we're going to do today is we're going to walk through ETFs, and for each one of these buckets, we're going to walk through what our analysts' favorite ETFs are in those buckets. We're not doing cash because cash is boring, but there's some beta shares cash ETF we like. Anyway, that's my setup. Now it's going to get exciting. You can feel the excitement building in the room. I'm in the room with Will and Shani, and they're both on their laptops doing God knows what, not paying attention to this. Instant messaging everyone else. I mean, Will's trying to get over the trauma of the ferry losing its steering, but you know. All right, so we're going to talk about Aussie equity first. So what I've done at the top is we've got these 5 different portfolios. And as I said, as we go from conservative to aggressive, we're recommending a greater percentage in Aussie equities. You can see from 5 to 30. Hopefully that's a little self-explanatory. So in Aussie equity, we have 4 ETFs that are part of these model portfolios that we recommend. So we'll go through each one of these quickly. So, all right, let's start this beta shares product at the top. So you can see the Morningstar rating. You can see the price as I quickly threw these slides together about 3 minutes before this thing started. But I was mentally preparing, and that's the important thing. So let's talk about each one of these ETFs. So what we like about this beta shares product. So first of all, the pricing we like. And the other thing is that it's a very different ETF. So this is based on a 4-factor method. So the index that this is tracking is based on this 4-factor method by the US firm Research Affiliates. And what they're doing is they're trying to find undervalued stocks. So basically trying to find value stocks. And they're using 4 different metrics. That's the 4-factor model. They're looking at book value, sales, cash flows, and dividends to form this index, and then beta shares has an ETF that follows that. So we like that. You can see the ticker symbol right there as well. Next, we're going to move down to this iShares small cap product. So what this looks at is obviously we're looking at Australia. We're looking at small caps. So small caps are the smallest companies. So generally you get more volatility, but over time, at least until the last 10 years, small caps outperformed large caps over long time frames until the market became so screwy after the GFC. All right, so what are they looking at here? So basically, this index is taking the 300 largest companies in Australia, the ASX 300, and eliminating the top 100. So you're getting those 200 underneath. So that's the index you're getting there. Now, with small caps generally, and we're using ETFs here, and it's an ETF model portfolio, small caps are generally a space where we do like funds actively managed products better than passively managed products, just because there's more opportunity in some of these less liquid and less paid attention to markets. So yeah, that's what happened. Now people are texting in the room, so they won't even pretend they're on their computer. But yeah, so generally we do like active products here, but it is an ETF. It is an ETF model portfolio, so we've included that. All right, the next one up. So we are looking at, this is a State Street Global Advisor product. This should be pretty familiar. So this just tracks the ASX 200. We like it because it's cheap and well managed. So they do have very low fees. They recently cut their fees again. So that's our favorite S&P ASX 200 tracking ETF. Finally, Vectors, Van Eck, Vectors Australian equal weighted ETF. So I talk about equal weighted indexes all the time. We like this because it's low cost and because what I'm about to talk about, it is more diversified than a regular ASX 200. So what does equal weight mean? So quickly, indexes are market cap weighted. So that means the largest companies make up more of the index. So what that means, especially with what's been happening in the market since the GFC, where we've had a lot of momentum and a lot of large cap growth stocks have done very well, what it means is you get a lot of concentration. So in Australia, of course, the concentration is in banks and it's in resource companies. So you're getting a lot of the ASX 200 from a market cap perspective. A lot of your money is going into those particular industries. Instead, an equal weight index says there's 200 stocks in here. We'll just put the same amount of money into each one. So what that gives you, particularly in markets that are very concentrated, like Australia, very concentrated among two different industries, what it gives you is more diversification across sectors. So that balances things out. Different markets are, of course, different. So a US equal weighted would give you less tech exposure, for example. So then you actually, like an equal weighted S&P 500, same thing. You get all 500. So it's a little bit of a different index feel. All right, we're going to keep moving, and then I'll get to some questions. Global equity. We have our first actively managed ETF. So people don't think about this, but there are actively managed ETFs, and they're becoming a lot more popular. So anyone who's been on these things before knows that our analysts love Magellan. So Magellan has produced basically the same global fund in an ETF. So this is the ETF. So you see it gets a gold rating, which is our highest. Now, Magellan's had a pretty tough 2020. Hamish Douglas, who's their manager, who Shani followed around like a puppy at our investment conference a couple years ago, he went pretty heavily into cash. I think he's very worried that the market's overvalued, and subsequently, because the market went up a lot, they underperformed. But we still like them. We still like their process. So this is our first actively managed ETF. All right, Van Eck Vectors. So this is a quality tracking ETF. So I talked about this on our last podcast episode, which we have not released yet. But if Will does not suffer any more ferry mishaps, maybe we'll get it out in a couple weeks. But yeah, talked about this one. What this is looking to capture is it is trying to find high quality global companies at an attractive price. Now this is an index, right? But the index is constituted to try to find these. So basically at the end of the day, they are looking at a couple different things. They're looking at return on equity, earnings growth stability, and low balance sheet leverage to put in this ETF. So there are not a lot of financials, for example, in this, because financials have big balance sheets. Next, we'll go down emerging markets. So why do you want to invest in emerging markets? Well, at the end of the day, what you're looking for is more growth than you would get in a developed market, although you realize that there's going to be a lot more volatility and that there's more socioeconomic and political risks. So yeah, if you're interested in emerging markets, we think this is a cheap, cost-effective way to access them. This Vanguard product, that's Vanguard for everything, a cheap, cost-effective way to access anything. You'll see if you go and look at our global equity exposure that we say 50% hedged. So we have this hedged product in here. So Vanguard, just following a broad international index. The hedged means that currency risk is removed from it. So that's what we have here. A opportunity to get exposure to global markets without currency risk. So we've talked before on these things about hedged products, but you can see there are a lot of hedged products. Don't worry, we're gonna get through the rest of this fast. Listed property, so real estate investment trusts at the end of the day. All right, so we've got another Vanguard product on here if you're sensing a theme. Now the Australian listed property sector is very, very small. So there are 47 companies listed in Australia that fall into the listed property, real estate investment trust bucket. So we feel that because it's so small, an index product is the way to go. It is difficult when you have such a narrow group of companies in there. It is difficult for managers to outperform that. So we think this is a good place to be passive. International listed property. So a lot larger. So basically the target benchmark for this is 250 companies in it. So same thing. We're looking at real estate investment trusts. Different companies obviously issued it, but that is our pick there. I feel like now I'm just moving through this thing. All right, we're back to our friends at Magellan. So global infrastructure. So global infrastructure, at the end of the day, and this is another actively managed product. You can see it's hedged. So currency hedge. That's what that means there. So basically what infrastructure is and what the definition is you need an asset that is essential for the efficient functioning of society and have profits that aren't overly affected by competition, commodity prices, or sovereign risks. So for a lot of infrastructure, you'll see like Sydney Airport. I know that they're going to build an airport, God knows where, that somebody will go to. But Sydney Airport's the only airport in Sydney. Is that insulting? Okay. Well, I don't know where it is. Well, I know that, but I don't know where that is. Anyway, a lot of infrastructure do have monopolies like that. So whether it's a port, whether it's an airport, whether it is something like Transurban that has monopolies on a lot of toll roads in different places, at least for long periods of time, that's where we're looking for infrastructure. And now we get to the exciting stuff, bonds. Everyone loves bonds. Hey, the Australian bond market. So basically, we're looking at government bonds here. It's pretty narrow market for government bonds. So we've got an iShares passive ETF. And then finally, why does my computer keep beeping? Finally, we've got global fixed interest. So once again, this is hedged, removing that currency exposure, and that is looking at government bonds globally issued by investment grade countries. So countries that at least the bond rating agencies believe have a good chance of paying you back. All right, we did it. Everyone's excited. Maybe just I'm excited. Okay, let's start getting into some questions. So if you have more questions, ask them. All right, so we've got a question from Vidania. If one wants to cash out, would it not be better to be in a fund rather than an ETF? Because the fund issuing company is bound to give you back your money within a set time limit, while an ETF, you may not find buyers at the price you want to sell. Yeah, so I guess we can address a couple different points here. Yeah, I mean, the advantages, obviously, as a fund, as you said, if you want to cash out for a fund, you don't have to pay a transaction fee. So that's one advantage. Now, it's going to take them a couple days to give you your money. So just remember that. It does take a while to get your money back. But yeah, an ETF, you may not find buyers at the price you want to sell. So that is an issue. I think with most ETFs, there's obviously enough liquidity that I think you can sell out, even if it's a price that you don't want to sell. Like all of us want to sell everything for more. But yeah, no, it's a good point about funds. All right. So we've got a question from Simone. This is weird. I feel like they changed Zoom. Now all sorts of stuff is popping up, which just confuses me. So in light of recent market commentary, I'm interested in value-based ETFs. Vanguard's value ETF tracks banks, coal-based resources, weapons, tobacco, liquor, gambling. It is extremely unattractive. ESG-based ETFs appear to be growth-based, tracking companies with high PE. Is the trend away from value really actually a trend towards ESG? All right, so that's a really good question. So there's a couple different things we can talk about here. So number one, let's talk about value versus growth. So at the end of the day, value versus growth is that we are just taking, can be a number of different metrics. So whether that's book value, whether it's price to earnings, we saw dividend yield, price to cash flow, all sorts of different metrics, and we're just ranking companies. And so depending upon what the index is, if we have a growth or value index, they're just going to take a portion of the companies that have the highest one of whatever these metrics are and put them in the growth portfolio. And then the cheapest ones are going to go into a value portfolio. In general, what the market used to do before, as I described it so eloquently, as screwy since 2008, what the market used to do is you'd see rotations. So sometimes a different stock or industry would do well, and then you'd have value stocks, and you go buy the value stocks, and the value stocks would do well, and the growth stocks would become value stocks. So you're in no way set in where you are, and so you used to see more of a rotation. We haven't seen a rotation since the GFC. It's been all growth, so just growth stocks did well. Now, generally, because we are looking at multiples that investors will pay, different industries have different multiples because different industries have different characteristics. So the things that have been valued highly by investors, and some of this makes sense, are a lot of technology companies, for example, because they have they've had good growth prospects, because they're very asset light, right? So they generate a bunch of cash that doesn't need to be invested back in the business. They're very scalable. So at the end of the day, you can get a lot more revenue and a lot more customers without hiring a lot of employees. You don't have to build some factory. So they've been trading at higher multiples. Many of those companies, as you pointed out, are also companies that get good ESG scores for all the same reasons, right? It's a lot easier to get a good ESG score when you have 10 people sitting in a basement on a computer than if you have to dig up half of WA to pull something out of the ground. So you're going to get better ESG scores. So I would say that none of this is planned, but it's just sort of the reality that investors are willing to pay more for companies that have smaller footprints. That translates well into ESG. We haven't seen any sort of rotation. So yeah, I mean, I think that's probably the issue that you're running into. So if you don't want coal, weapons, tobacco, liquor, gambling, that's like a night out with Will, minus the coal. But yeah, everything else was included. Do you like how I didn't include you in that? Yeah, in case your mother's watching. Oh, Lisa says, hope Equity Mates goes well. They have some great guests, so you're in good company. Number one, Lisa, I can't believe you're listening to the Equity Mates. It's just, yeah, it's a weird way to find out that you're cheating on Shani and I and Investing Compass. But yeah, I hope it goes well too. I think they've had great guests until tonight. Yeah, we'll see what happens. Okay, so Joshua has a question. Would you not be looking at more quality ETFs during uncertain times? Yeah, I mean, I guess a couple comments I'd say about this is, unfortunately, I think we're always in uncertain times. People just forget about them and they look back and they're like, oh, stuff was a lot better back then, but we were worried about something else back then. But yeah, no, I think, personally, I think the market's very overvalued. So I would say quality, I do think, is something that's important. We had a lot of quality tilted indexes there. So yeah, I mean, I think that our manager research team that's selecting these is acknowledging that perhaps this is a good opportunity to focus on quality rather than all the speculative stuff that your friend's uncle's cousin just got rich off of. So yeah, I think that's a good comment. Okay, so we have a question from our favorite attendee, the anonymous attendee, saying, I'm a bit confused, I confuse everyone, about what you're saying in relation to bond index funds. You're saying that the Aussie government bond fund is so stable that it's okay to use as an index fund. Okay, so what I was saying is that the market is very narrow. So let's talk about, I didn't spend a lot of time on this, let's talk about sort of active versus passive. So that's what I was saying in terms of an index fund. So when is it better to use active? Generally, it's better to use active in fixed interest, and we'll get into why in a second. It's just Australia is a little different. You want to use passive funds generally, right? if you go back and look at where all of this comes from, is we do a report here at Morningstar called the Active Passive Barometer Report, where we look at different asset classes and we just go back 10 years and we say, what's the percentage of active managers that outperform their benchmark? And so what this tells us is, number one, in more efficient markets, it is harder to outperform your benchmark. So an efficient market is a market that, well, it's kind of a backwards thing. An efficient market is a market where we think that there is less difference between what something is worth and what something is trading for. So this is underlying stocks, for example. And the reason markets are efficient often is because there's a lot of attention on them. So larger markets, think ASX 200, S&P 500, it's a lot harder for managers, active managers, to beat those markets because everyone in the world's concentrated on them. Because they're large, everyone in the world can invest in them. There's all these analysts trying to figure out what something is worth. So you don't see those large deviations, generally, between price and value. In less efficient markets, small caps we talked about, fixed interest, there is more of an opportunity. And history shows us there's more of an opportunity for active managers to outperform and beat their benchmark. The other thing is the size of the market. So the investable universe relative to the benchmark is also really important. And the reason for that is that managers that have a giant, so like if I'm in S&P 500, that's my index that I'm trying to beat. There's 500 stocks, right? So I can go out there and pick whatever I want. But still, the index is pretty representative, especially because of the way these market-weighted indexes are. But if you're out there in global fixed interest and there are thousands and thousands of different bonds, the index is pretty narrow compared to that giant investable universe that could be in my mandate as a manager. So the bigger it is, the more of an opportunity I have to outperform. So what I was saying about the Aussie government bond fund is that unlike most fixed interest markets that are enormous, the Australian one isn't that big. So there's not many bonds to go out and pick from. So that's just the point I was making. All right, we've got a question from Polly saying, do ETFs have P/E ratios? Well, they do. I'll show you. I mean, they don't, and they do. Does that make any sense? Did you get that? Obviously, what you can do with an ETF is you can look at the underlying, securities in that and just roll that up, and that's the ETF. So I'm going to go into, where are we going to go? We changed the website. Now I can't find anything. We want to look at ETFs. All right, let's go into, well, that's no fun. We'll go into active. So this is Medalist, our top ratings, active global equity. We'll go into this Magellan Global Active ETF. So if I go into portfolio, here you go. So basically what we've done here is we've rolled up all the securities that are in this ETF, and we've looked at the price to earnings ratio as well as a number of other ratios. And then you can compare it to the category average, so the category that this ETF is in. So probably global equity. Equity World Large Blend, there we go. We look at the index. So this is MSCI World X Australia Index. So you can compare it to the index, the category average, etc. So yes. All right, Rodney, what should happen is Rodney should just come in here and do these things. It would make my life easier. So Rodney says there are at least 5 ASX listed value ETFs across a couple different providers. Most are global, so VVLU, VGMF, EMK, this is like an eye test, KT, AUMF, WDMF. So that was a lot of letters that I just rattled off at you, but thank you, Rodney. Once again, if you're ever available between 1 and 2 p.m. Tuesday, Thursday, you can come in here and do these. All right, so we've got a question. We've got a Warren Buffett question. Warren Buffett said buy REITs instead of real estate. Should we follow his move? Always follow Warren's move. Yeah, so let's talk about REITs versus real estate. This will allow me to go into my real estate diatribe, which everybody loves. Yeah, there are a couple of problems with buying real estate, and namely with the problem with buying individual real estate. Now, I own some individual real estate, not that I live in. I guess I'm a rent investor or whatever it's called, but it's in the U.S. and I'm not allowed to go back there. But Mom, if you're on here, sorry. But yeah, so the problem sometimes with real estate is obviously you can't diversify as easily because properties are very expensive. So at least the advantage that you get with REITs is the ability to diversify. And I guess people don't really think about this. What are you concentrating in if you go out and buy an investment property? Well, you're concentrating whatever place you bought it. So that could be very dependent upon the local economy. And I know like me saying this in Australia where housing prices only go one direction sounds stupid, but you're also very dependent upon that property as well. So even think about neighborhoods and changing preferences and things like that. And also you could buy a lemon of a house that continues to break and you have to pour more money in. There's all sorts of issues. So I think that's probably Warren's point. Not that I should be trying to interpret what he says, since he's obviously much smarter than me. But yeah, that's probably his point, that at least with real estate investment trusts, you do have the opportunity to diversify. So Mim is asking, is gold included in any of these portfolios? I feel like Mim has not been on forever. Welcome back. Is gold included in any of these portfolios? No, it's not. So we're not wild about gold here at Morningstar. But yeah, hey, not my call. All right, so Dennis is asking, what is the advantage of an ETF over a managed fund? Good question. Yeah, I mean, the advantage of ETFs are some of those things that we talked about. Listen, it's easier to buy an ETF for one thing. If you are buying a single ETF, if you're investing a certain amount of money, if you're going to invest $10,000 and you are going to keep it in something for 10 years, you get lower fees with an ETF. So that's one big advantage. The problem is I think ETFs are better suited for sort of buy and hold than funds, where if you're continually investing more money in them, a fund is probably a better choice. But you are getting lower fees, so the management fees are generally lower. You do have more flexibility. Now, that can be a good thing as long as you don't overuse it. But yeah, I think those are the main advantages. All right. Is there a Morningstar article that covers the recommendations that you are making today? I think I need to say, first of all, I'm not making recommendations. I'm just providing information. We are shooting a video, today, tomorrow, Tim Murphy and Emma. Today, yeah. Emma leads our editorial team. There was a big crisis during stand-up today because she forgot to bring appropriate clothes to wear on video. But anyway, as long as she can find something to wear, we're going to shoot a video today. So we should have that video out next week, maybe, Will hates me. But yeah, so we should have a video that's out there right now. And if you want to see our ETF model portfolio, send me an email. I'm going to regret doing this, but yeah, send me an email, mark.lamonica1@morningstar.com.au. It cannot be any worse than the email I got the other day. Mate, it's an email address. Okay. Yeah, but I can't talk about that. So Dennis is saying, sorry, I meant a listed managed fund. So listed managed fund, so I think you're probably talking about, there are funds now, M funds that trade on the ASX. So yeah, I mean, you're basically faced with some of the same stuff with an ETF, right? That there's a transaction cost, that it's on an exchange. But yeah, I mean, I don't think there are any real structural differences. I would just look at fee levels. Yeah, so Rodney, soon to be co-host, saying quite a lot of traditional managed funds are now also dual listed. So they're available as an ETF, also on the exchange. Yeah, so that's that Magellan example I used, for example. So because ETFs are so popular, and I, of course, attributed this to marketing, but people really like ETFs. So what are fund companies doing? Well, they're just replicating the same thing as an ETF, which I think is great. So just look at the different fee levels that you're paying. So now we have the people that ask questions in chat. We'll go over here. So Richard says Magellan finally started to perform in recent months. We can ask Shani if Hamish said anything to her before the conference to indicate this. But yeah. All right, so really good question by Juan. So Juan is saying, is it better to have more than one ETF per segment? Say 2 for Australian equities. So yeah, what I would say is make sure they are doing different things. So a lot of people think that like diversification is I'll buy 4 different ASX 200 ETFs. Well, don't do that. So that's not a good idea because you're just having 4 times as many transaction charges. And they're all the same at the end of the day. Now, we obviously think some are better. And in that case, it's looking at fees and looking at their ability to manage those fees. But yeah, I would just make sure that if you do want to invest in different ETFs per segment as we went through, remember each one of those ones I went through, like in Aussie equities, they were all doing very different things. There was a small cap one, there was a quality one, like they're all doing different things. Even though they were tracking indexes, the indexes were always different. So that's what I would make sure on. Do ETFs fail/close? And if so, what happens to the shares? I assume you're talking about the ETF shares. Now, hopefully ETFs do not fail. So I don't think they're going to fail. But yeah, if they close, you I assume just get your money back. Well, you're going to get your money back. I don't know the exact mechanism, but yeah. All right, so good question from Juan. With rising interest rates, would it be better to buy actively managed fixed income funds? Okay, so let's talk about that. Maybe. So what happens when interest rates go up? Bond prices go down. So a good trick is go on and look at the duration of anything that you are invested in on the fixed interest side. So basically duration, and it's generally measured in years, measures the impact of interest rates. Now this is looking historically, so things could change, but generally they're right. Looking at the expected change in this case, ETF price based on a change in interest rate. So if you see a duration of 6, for example, that means if interest rates go up by 1%, and remember, bonds always move inversely with to interest rates. If interest rates go up by 1%, the ETF should go down by 6%. Now, obviously, it's not going to be exactly 6, but it's showing you the duration. So a higher duration means it's more interest rate sensitive. So in rising interest rates, bond prices go down, so you would want lower duration. Now, an actively managed ETF the manager would have the ability to manage duration more in that portfolio rather than just following the index. So the question would be, does the active manager, does he or she know the right direction, or can they predict the right direction of interest rates? If they can, then yes, it would be better. If they can't, then no, it would be worse. So it's really, once again, up to the skill of the manager, but the manager can decide and make bets on not only the direction of interest rates, they can make bets on the yield, the shape of the yield curve. They have a lot more leeway to position themselves. Now, they have to position themselves correctly for what's going to happen, but if they can get that right, then yes. It's the same thing. It's the same thing that you could say for an active manager, right? So like if I buy a passive S&P 500 fund and the market goes down, well, I know how much it's going to go down. My fund or my ETF is going to go down the same as the market. If there's a smart enough manager that decides that he or she wants to go into cash, and a lot of cash before a market fall, then yeah, you're going to do a lot better. But they have to get that right. But it's a good question. Oh, this is a good one. A general question. What are your thoughts on the newly established cryptocurrency ETFs? Well, I can't say too much about ETFs or about crypto, or will get very upset. Yeah, so I mean, I think what basically has happened is the Canadian regulators approved the first ETF first crypto ETF. So all these people have been applying in the US to try to get one of these, including the Winklevoss twins, who I actually know. I went to school with their sister. But yeah, including the Winklevoss twins are trying to open an ETF. The SEC in the US, the regulatory body, kept turning them down. Canada's finally done it. And I shudder at these words, but the world will probably follow Canada and other people will open them up. Following Canada is a big mistake. But and that's just American humor. We make fun of the Canadians. When I say stuff in Australia, they're always shocked that I'm being so offensive about the Canadians. Yeah, I mean, I guess it's your thought on crypto at the end of the day, right? So it's an efficient way for people to get into crypto. So it could probably create a lot more demand, for one thing, that's a little easier to get in there. It just depends on what you think about the price of crypto. What do you think about that, Will? That was balanced and even-handed.
Germany as well.
Oh, Germany. Okay, now we're following the Germans and the Canadians. There we go. All right. So now that I've insulted most of the people in the world, why don't we finish up today? So if anybody has any questions, please email me at mark.lamonica1@morningstar.com. I'll probably get back to you tomorrow because I have to go drink beer with the equity mates and talk about liquor stocks. But and start beef. Yeah. So Shawnee wants me to get in a rivalry, like a podcast rivalry with them. It's a little like West Side Story, right? But anyway, thank you guys for joining, and I'll be back on Tuesday if Will will show up and film it.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.